We warned about this last time, but this was a wake-up call for the entire 1 quadrillion notional value over-the-counter markets. And it was the fracturing of this mechanism in March 2020 that began to trigger a nickel-like over-the-counter market short squeeze. But because officials were able to step in and avert a CME default, the too big to fail market maker banks were saved. But this brings silver into focus.
Well, now you got my attention, Andrew. I know just before we started recording this episode, you had mentioned the connection between exactly what you just said there, silver, and what happened in the nickel market. Can you maybe share with our audience what's happening here? It's fascinating.
Yeah, I know there's been a lot of everything. Mainstream is trying to divorce this, what happened there, and silo it from what's going on anywhere. No way. Following successful, look, this follows successful lobbying efforts years ago. In fact, it was last year, to block transparency in the metals markets. The over-the-counter metals market has come under growing focus following this nickel squeeze. I wish they wished it hadn't happened. And while the focus is on what happened following the nickel short squeeze, the lack of regulation in the multi-trillion-dollar over-the-counter markets and the exposure leading into the too big to fail taxpayer-funded banks for all the metals is now back on the table. Now, the Bank of England, FCA, will investigate governance markets oversight and risk management after the largely self-regulated LME admitted it had, get this, no visibility of the large over-the-counter short position in the nickel market prior to March the 8th. Now, this is exactly the same situation with COMEX and related SLV and GLD ETFs, which are riddled with bilaterally settled, unbacked, over-the-counter short positions. Our focus is on the vulnerability of the COMEX and SLV silver paper hedging mechanism and the equally unbacked, large, highly leveraged, over-the-counter position concentration currently wagging the tail of the silver physical market. Now, lifting this smaller LME stone exposes an exponentially larger naked short over-the-counter position in silver. And this week, we evidenced the primary lessor of the reported OCC Bank of America lopsided derivative bets, that was the Bank of America, if you remember, exposed JP Morgan and Standard Chartered as the largest counterparties, both of which are trying to scurry out of the light by exiting position concentration in the base metals space. However, the outflow of paper market liquidity will impact all over-the-counter metals markets. It's got the attention of the Bank of England and the FCA. And given unregulated, unbacked over-the-counter longs are hedging unbacked paper short silver positions, it's going to spill into all exchanges, including COMEX and SLV, especially the SLV COMEX paper silver flywheel. Now, for its part, the LME scrambling has agreed to increase transparency and in its markets by forcing members to disclose off-exchange over-the-counter positions with their clients. Hey, that's never been done before, and it has been doing this in the nickel market since mid-March, but it will now extend to all metals. They appointed an independent party, to conduct a full forensic research of trading leading to the disciplinary action and the market reform. Okay, sounds like gobbledygook, but it is. It really is an independent one. And we've done some checking with our contacts that suggest that this will be independent. Now, the LME has also agreed to strengthen its governance by appointing additional independent directors according to what they were saying. This is what they put in writing. I mean, I'm always suspicious of when a director's appointed. But anyway, from what we've seen in the LBMA for many years. But look, this is undoubtedly what has sparked very credible rumors on Monday, a couple of days ago, that JP Morgan also wants to call in its Bank of America lease positions before an inevitable short squeeze is triggered in silver. Why would you want to be in this trade now? And if you remember, it was back a couple of years, 2000, I think it was a couple of years ago, 3 years ago now, following these meetings we had with the Treasury, the head of the FCA, the Bank of England. In fact, that was Andrew Bailey at the time, who was the head of the FCA at the time before he became a Bank of England governor. And we had our MP, Jeremy Lafloy, acting as a witness. The FCA admitted that this the EFPs are a completely unregulated conduit. But realizing the potential of the too big to fail bank derivative exposure, which was read out in Parliament, it called in the heads of the LBMA to demand reporting on the less than 14-day rollovers, which we talked about in previous episodes. But in other words, you can just roll stuff on and on and on without any form of disclosure. Now, so putting this EFP tool into the regulator's crosshairs, it removes the primary tool for the insiders and officials to settle non-delivery obligations in the unregulated over-the-counter market. The reason these contracts have flown under the radar is that in plain vanilla form, EFPs are simply the squaring of a simultaneous buy and sell order. However, it is the smoke and mirrors over-the-counter squaring leg that is in question. EFPs offer up some legitimate arbitrage opportunities, and that's why they still exist. But the majority of the massive tonnage volumes transact when it makes zero sense to utilize this EFP conduit. It is the COMEX to over-the-counter conduit that finally is now under scrutiny, particularly the unreported over-the-counter flywheel. Now, during the 7 months into the EFP blow-up, that's when we went into Parliament, 7 months before March 2020. We had formally drawn regulators' attention to the loophole, exposing the UK banks to potentially trillions of dollars of naked short derivative positions. Exactly what is just exposed in the nickel blow-up. But of course, little was done. And of course, the March 2020 EFP implosion finally triggered the action to shut the EFP loophole. It is still open, but it is, but by the BIS implementing Basel III NSFRs in January, it was essentially started to be contained. So the LBMA is, let's face it, the Achilles heel, and is still exposed as the directly related spot index positions can and will be demanded for delivery in London. Ultimately, this is bullish for the US dollar price gold, regardless of the scramble to hold gold down and regardless of geopolitical escalations. So Shane, really, to sum up, in the very short-term gold action, following Putin signing off the ruble for gas, energy, oil, and now including the whole commodity trade, officials are undoubtedly intervening in the ruble US dollar cross. However, liquidity is limited, as we've explained, and selling paper gold post the PM fix to leverage this play, which we see regularly, is destined to backfire in both gold and silver futures, which are now deliverable. Also, liquidity providers representing active sovereign buyers currently price spot at, as we say, 2200, and will continue to buy EFP-derived spot gold positions for physical delivery. In addition, given the ruble energy trade will build momentum, most are pricing in the forward exchange rate closer to 70 to 1, which prices it well above 2000. So, the gold floor is not even on the radar of most US-centric traders, siloed to the casino, but explains why insiders quickly run out of spec paper market long stop short cover. In other words, they need short cover. So you only sell and pull bids to get short cover. You don't want to take on that naked short position yourself, because it's a very strong demand physical market driven by a wide open gold window to secure physical gold sub 2200. Officials know this.